Hi, thank you for watching Digging to China. I'm Dong Xiong. If you have not done so already, please subscribe to my channel. Thank you very much. Today, let's discuss China's foreign exchange reserves. On November 6, the Beijing government published import and export data for October. What's intriguing is that despite export numbers failing below expectations, there was a counterintuitive rise in imports. Let's delve into the data. In October, China's year-on-year export declined by 6.4%, surpassing the expected 3.5% decrease. Surprisingly, imports saw a 3% increase year-on-year, in contrast to the anticipated 5% decrease. Considering the consistent trend of decreasing imports and exports in the previous months, the substantial rise in imports for October is worth investigation. A closer look at the custom import commodity list reveals that the import surge is primarily driven by significant purchases of commodities such as grains, soybeans, refined oil, natural gas, and other bulk products. This development bears a resemblance to preparations, possibly in response to military readiness under the leadership of Xi Jinping. Further observation is required to determine if this trend persists over the coming months, particularly if there are continued substantial imports of food, energy, minerals, and similar items, which could indicate preparation for potential conflict or a response to economic sanctions. Apart from the trade data, the People's Bank of China has also disclosed the foreign exchange reserve data for the end of October. In October, China's foreign exchange reserves decreased by $13.85 billion, marking the third consecutive monthly decline. Another noteworthy statistics linked to foreign exchange reserves has been sparking discussions both nationally and internationally. It pertains to the direct investment liabilities in the third quarter of this year, which recorded its first negative value in recorded statistics. It amounted to a deficit of $11.8 billion, signifying that between July and September this year, there was an outflow of foreign capital from China exceeding the inflow by $11.8 billion. This situation, where more foreign capitals left China than was invested, is unprecedented in China's history of over 40 years of reform and opening up. It indicates a significant and comprehensive departure of foreign investments, raising concerns and discussions. This continuous decrease in China's foreign exchange reserves over the past few months can be attributed to three primary factors. First, a significant decline in exports has resulted in reduced foreign exchange earnings. Second, China may be actively accumulating strategic reserves of essential wartime supplies, leading to increased imports of commodities like grains and energy, which require more foreign exchange expenditure. Third, the outflow of foreign capital from China is further depleting the foreign exchange reserves. Considering the ongoing trends, it's foreseeable that China's foreign exchange reserves might continue to decrease. Furthermore, data from the State Administration of Foreign Exchange exposes an additional point of concern regarding China's outbound investments. Xi Jinping seems to have placed a significant bet on Chinese companies expanding overseas in the realm of electric vehicles. Let's now explore the potential risks associated with China's foreign investment in this manner. Let's start by examining the scale of China's overseas investments in recent years. You can find this data on the official website of the State Administration of Foreign Exchange. We will focus on a specific data point: outward foreign direct investment, which represents the annual amount of China invests abroad. This figure has consistently exceeded $130 billion since 2015. Several factors contributed to this trend, including the Belt and Road Initiative. President Xi Jinping introduced the BRI in 2013, and in subsequent years, China established various institutions and investment banks, paving the way for extensive overseas spending. Although China's outbound investments have been at a high level since 2015, we've noticed that in recent years, the amount of foreign investments entering China has consistently exceeded China's outbound investments. In the past year, despite a slowdown in China's economy, foreign direct investments into China reached $180.2 billion, surpassing China's outbound investment, which amounted to $149.7 billion for the entire year. However, when we look at the quarterly data, a significant trend emerges. Starting in the third quarter of last year, China's outbound investments began to surpass foreign investments entering China, and this deficit has been growing ever since. By the third quarter of this year, the deficit has expanded to $65.8 billion, and over the first 3 quarters of this year, it reached $127.4 billion, almost matching China's total outbound investments for the entire previous year. Therefore, if China's overseas investments fail to yield profit, it will have a substantial impact on its foreign exchange reserves. So, which sectors have been the focus of China's overseas investments? One prominent area is the Belt and Road Initiative. As mentioned earlier, China's overseas investment increased in response to President Xi Jinping's initiation of the Belt and Road projects. Unfortunately, many BRI projects have not proven to be profitable. This is because Xi did not prioritize profitability as the primary goal. After observing these projects over the years, it has become evident that the primary objective of the BRI is political rather than economic. For instance, in Sri Lanka, the CCP secured projects by bribing local government officials. These projects included extravagant government office buildings, unnecessary luxury airports, and ports. In the end, Sri Lanka found itself heavily indebted to China. However, China's intention was not solely to recoup its investments. It was primarily about asserting control of Sri Lanka's port. From an economic standpoint, these outward investments driven by political objectives are unlikely to generate a substantial foreign exchange earnings. Even the debts owed by these impoverished countries to China might come under pressure to be reclassified as donations by international organizations. Therefore, the notion that the Belt and Road Initiative would significantly bolster China's foreign exchange reserves is far from the truth. To put it frankly, with China's economic currently experiencing a slowdown and a contraction in the domestic market, overseas investments have emerged as a potentially effective strategy for breaking through these challenges. However, a key prerequisite for success is making investments in the right sectors and right regions. Surprisingly, in light of China's recent tangible overseas investments, the Chinese Communist Party seems to be placing its bets on electric vehicles. Over the past couple of years, domestic electric vehicle brands have been consistently expanding their presence in foreign markets. For example, BYD has invested 4.5 billion yuan to establish a factory in Brazil and 3.4 billion in Thailand. Geely Automobile has committed 60 billion to create an industrial park in Malaysia, while Great Wall Motors has invested over 10 billion in Thailand. Additionally, Chery has embarked on a 2 billion investment in Argentina. When you aggregate the amounts these automotive companies are putting into their overseas expansion, the total easily surpasses 100 billion yuan. Given the substantial amounts involved, it's evident that these investments are supported by bank loans. Obtaining loans in the tens of billions or even hundreds of billions of dollars for overseas ventures typically requires personal approval from Xi Jinping. This highlights the high expectations Xi Jinping has for the electric vehicle industry, with the aspiration that these companies going global will bring back foreign exchange earnings. Among these electric vehicle firms, the BYD stands out as one of the most unique. A look at the BYD's balance sheet reveals the following. As of the end of 2022, BYD had total assets of 4,939 billion yuan and total liabilities of 3,725 billion, resulting in a debt-to-asset ratio of 75%. 0.42%. By the third quarter of this year, BYD's total assets increased to 6,233 billion, with total liabilities reaching 4,822 billion, resulting in a higher debt-to-asset ratio of 77.34%. In recent years, BYD has seen a consistent increase in its debt-to-asset ratio. In theory, securing loans from banks becomes challenging when operating with such high debt-to-asset ratios. Let's consider Tesla, whose debt-to-asset ratio remains slightly over 40%. Among the other Chinese automakers embarking on international investments alongside the BYD, Geely maintains a debt-to-asset ratio just above 50%, while Great Wall Motors stands at just over 60%. These automakers all exhibit lower debt-to-asset ratios compared to BYD. Nevertheless, BYD continues to receive loans from various state-owned Chinese banks despite its significantly higher debt-to-asset ratio. This suggests a strong backing or support for BYD from influential sources. In recent years, BYD has become the leading figure in China's electric vehicle industry, thanks to the endorsement of Xi Jinping. With Xi Jinping's backing, there seems to be very few limitations on the financial support BYD can secure. However, I can't help but think that Xi Jinping might once again have been skillfully manipulated by the financial system. While many struggle to secure loans, Xi Jinping's endorsement allows the financial system to provide substantial loans to BYD with confidence, even if this support leads to BYD becoming the next Evergrande Group. The ultimate responsibility would still lie with Xi Jinping. All of this is a consequence of the decision to utilize political influence to endorse a private enterprise. However, for companies like BYD, which have the safety net of government policies supporting their overseas investments, the assurance of reduced operational risks doesn't necessarily guarantee profitable foreign earnings. The first reason is that competition in overseas markets primarily hinges on the product itself. For example, why can't Chinese electric vehicles enter the US market? It's because China can't produce electric vehicles that meet US import standards. As a result, Chinese-made electric vehicles are mainly positioned in the low-priced segment, targeting specific countries like Russia, Southeast Asia, South America, and some parts of Europe. The second risk lies in China's lack of control over the core technology of electric vehicles. If other foreign automakers achieve breakthroughs and lead in electric vehicles technology, Chinese companies may face challenges and a defeat in intense competition in overseas markets. The extensive overseas factory investments made by Chinese automotive companies will require several years at the very least to recover their initial costs. However, during this time, the progress of electric vehicle technology and the industry's overall trajectory remain uncertain. For example, if electricity prices surge, leading to charging costs comparable to gasoline expenses, the entire electric vehicle market is likely to shrink. You can witness this situation in China's domestic market, where charging fees have consistently increased, ultimately revealing that electric cars might not provide the fuel savings they initially promised. Finally, there is one more major risk to consider, and that's the environmental factor. In regions that prioritize environmental concerns, such as the European Union, there may be future policies mandating that all electric vehicle batteries must be serialized to indicate their manufacturer. When these batteries reach the end of their lifespan, it would be the manufacturer's responsibility to retrieve and properly dispose of them. Even this year, the European Union forced Apple to switch to a Type-C charging port for their phones, despite Apple's significant size and public relations capabilities. Given China's understanding of Western world regulations and its public relations capabilities, can Chinese electric vehicle companies expect to operate freely in an environmentally conscious global market? China's substantial production of electric vehicles raises questions about the volumes of batteries that will need to be managed in the future and the associated costs. The issue of whether these batteries will be repatriated to China for recycling or processed in the host countries becomes pivotal. The ability of Chinese automakers to meet the stringent environmental requirements of foreign nations regarding battery recycling is also a critical concern. Failure to adhere to these standards could lead to market expulsion. The environmental risks that electric vehicles might confront in the future pose a significant threat to the entire industry. Therefore, China's wager on the electric vehicle trend is indeed a gamble, not just concerning the future of individual companies, but also the entire industry that embodies Xi Jinping's Chinese dream. Given the inherent risk of investments, especially the historical association of overseas investments with money laundering and a capital flight for Chinese companies, China had a few notable foreign assets. Subsequently, Xi Jinping initiated the Belt and the Road initiatives, depleting foreign exchange reserves further. Only now does Xi Jinping seem envious of Japan, with its globally renowned companies like Honda, Toyota, Sony, and Panasonic, which operate factories worldwide. These companies not only have substantial overseas operations, but also wield influence through unions that can impact local politics. For Xi Jinping, this combination of financial success and political influence is a coveted aspiration. However, facing the stark reality, the collective overseas endeavors of electric vehicles companies have already absorbed billions of Xi Jinping's investments. Yet, there is no guarantee of the desired return in foreign exchange reserves. The potential political benefits may also remain elusive. Consequently, China's overseas investments could turn into another risk, depleting foreign exchange reserves, possibly leading to an outcome similar to the Belt and the Road initiative. Thank you for watching. Please leave a comment and subscribe to my channel. Just click the subscribe button right here. I'll see you again shortly. Until then, be well.